Running a small business comes with its share of challenges. From managing day-to-day operations to maintaining growth, the financial health of your business is crucial for its long-term success. Understanding and keeping track of key financial metrics is an essential step for any small business owner who wants to stay on top of their finances, make informed decisions, and drive profitability. Financial metrics provide insights into how your business is performing, where improvements can be made, and where your business stands in comparison to industry standards. In this video, we will explore the top 10 financial metrics every small business should track to ensure sustained growth, profitability, and financial stability. Whether you're just starting or looking to refine your financial strategy, these metrics will give you the tools you need to measure performance, identify issues early, and make smarter decisions. 1. Revenue, sales. What it is. Revenue, also known as sales or turnover, represents the total amount of money a business earns from its core operations, such as selling products or services, before any expenses are deducted. Why it's important. Revenue is the lifeblood of your business and a clear indicator of your business's financial health. It's the starting point for evaluating your business performance and is the most straightforward metric to measure growth. Keeping track of revenue trends will help you understand if you're meeting your sales targets, growing your customer base, or if you need to adjust your marketing or product strategies. How to track it. Track your revenue on a monthly, quarterly, and annual basis. Break it down by product or service to identify your top performers. Comparing revenue trends with industry benchmarks can also offer valuable insights into how well you're doing relative to your competitors. 2. Net profit margin. What it is. The net profit margin is a financial ratio that shows the percentage of revenue remaining after all expenses, taxes, interest, and costs have been subtracted from total sales. It is calculated by dividing net profit by revenue and multiplying by 100. Why it's important. The net profit margin reveals how much of your revenue is translating into actual profit. A high net profit margin means your business is efficient at managing costs, while a low margin indicates that you may need to optimize your expenses or increase revenue. Tracking this metric is crucial for ensuring long-term profitability. How to track it. Calculate your net profit margin regularly by subtracting all your business expenses from your total revenue, and divide the result by your revenue. Aim for consistent or improving profit margins over time. 3. Cash flow. What it is. Cash flow is the net amount of cash being transferred into and out of your business. It includes all the incoming and outgoing payments, such as sales, loans, and vendor payments. Why it's important. Positive cash flow is essential for the survival of any business. Without sufficient cash flow, even a profitable business could face liquidity problems. Cash flow gives you a snapshot of your company's ability to pay bills, meet payroll, and reinvest in growth. Monitoring cash flow helps you avoid running into cash shortages, enabling you to make adjustments as needed to maintain a healthy financial state. How to track it. Track cash flow weekly or monthly to identify any patterns of negative cash flow early. Utilize accounting software to create cash flow statements or keep a simple cash flow spreadsheet that includes all your business's income and expenses. 4. Gross profit margin. What it is. The gross profit margin is a financial metric that shows the percentage of revenue left after subtracting the cost of goods sold, COGS. It's calculated by dividing gross profit by revenue and multiplying by 100. Why it's important. Gross profit margin measures how efficiently you're producing or delivering your products and services. A higher gross profit margin means your business is able to cover its operating expenses and generate profits. If this metric is low, it suggests that you need to reduce costs or adjust pricing strategies. How to track it. Calculate gross profit by subtracting COGS from revenue. Then divide the gross profit by total revenue. This metric should be tracked regularly to ensure you're managing production costs effectively. 5. Operating expenses, OPEX. What it is. Operating expenses, OPEX, are the costs required to run your business that are not tied directly to producing goods or services. These include rent, utilities, salaries, marketing expenses, and administrative costs. Why it's important. Keeping a close eye on operating expenses helps you identify areas where you can cut costs and improve efficiency. High operating expenses can erode your profit margins, even if your revenue is strong. By tracking OPEX, you ensure that your business is operating within budget and is financially sustainable. How to track it? Regularly monitor all your recurring expenses and compare them against industry averages. Aim to keep operating expenses as low as possible without sacrificing quality or customer satisfaction. 6. Accounts receivable turnover. What it is? Accounts receivable turnover is a ratio that measures how efficiently your business collects revenue from credit sales. It is calculated by dividing net credit sales by the average accounts receivable balance. Why it's important? A high accounts receivable turnover indicates that your business is collecting payments quickly, while a low turnover may suggest that you are struggling to collect payments on time. Efficiently managing receivables is crucial for maintaining a healthy cash flow. How to track it? Track the average time it takes to collect payments and monitor your aging accounts receivable reports. Set payment terms and follow up with customers promptly to ensure timely payments. 7. Debt-to-equity ratio. What it is? The debt-to-equity ratio is a financial ratio that compares your business's total debt to its equity, owner's investment. It is calculated by dividing total debt by total equity. Why it's important? The debt-to-equity ratio provides insight into your business's financial leverage. A high ratio means your business relies heavily on debt financing, which can be risky if cash flow is unstable. On the other hand, a low ratio suggests that your business is more reliant on equity or retained earnings to finance operations, which can be a safer option for growth. How to track it? Regularly monitor your debt levels and equity to ensure a healthy balance. A ratio of around 1:1 is generally considered acceptable, but this may vary based on your industry. 8. Return on assets, ROA. What it is? Return on assets, ROA, is a profitability ratio that measures how efficiently your business uses its assets to generate profit. It is calculated by dividing net income by total assets. Why it's important? ROA indicates how well your business is using its resources to create earnings. A higher ROA means your company is generating more profit for every dollar of assets it owns, while a low ROA may suggest inefficiencies or underutilization of assets. How to track it? Calculate ROA periodically by dividing net income by the average total assets over the same period. Monitor your assets and ensure that you're maximizing the return from each one. 9. Current ratio. What it is? The current ratio is a liquidity ratio that measures your business's ability to meet its short-term obligations with its short-term assets. It is calculated by dividing current assets by current liabilities. Why it's important? A current ratio greater than 1 indicates that your business has enough assets to cover its short-term liabilities. If the ratio is too low, it suggests potential liquidity problems, which could make it difficult for you to meet operational costs or settle debts in the short run. How to track it? Regularly calculate the current ratio to ensure that your business has adequate liquidity. Aim to keep this ratio above 1, though the ideal ratio may vary by industry. 10. Customer acquisition cost, CAC. What it is? Customer acquisition cost, CAC, is the total cost of acquiring a new customer, including marketing, sales, and promotional expenses. It is calculated by dividing the total cost of acquiring customers by the number of customers acquired during a specific period. Why it's important? CAC helps you understand how much you're spending to gain a new customer and whether that cost is sustainable in relation to the lifetime value, LTV, of a customer. A high CAC can indicate inefficiencies in your sales and marketing strategies, while a low CAC suggests that you're acquiring customers cost-effectively. How to track it? Track your marketing and sales expenses and divide them by the number of customers acquired in the same period. Regularly assess whether your CAC is in line with your revenue and profitability goals. Financial metrics are the backbone of any successful small business. By regularly tracking these 10 key metrics, you can gain valuable insights into your business's performance, spot problems early, and make data-driven decisions. Monitoring your revenue, profitability, cash flow, and other financial indicators will ensure you remain on track and help you adjust your strategy to meet your long-term goals. Whether you're in the early stages of your business or looking to scale, staying on top of these financial metrics will provide a clear picture of your company's health and give you the tools you need to make informed, strategic decisions. Make these financial principles a habit, and your business will be better equipped to grow, thrive, and succeed in an increasingly competitive marketplace.